Today we're going to discuss tax penalties associated with the Employee Retention Tax Credit and potential resolutions for those penalties with the IRS. So first of all, the IRS has been very clear in a lot of its guidance and a lot of the warning letters that it has issued to taxpayers. Regardless of the situation that a taxpayer is in or who they used as the preparer for their Employee Retention Tax Credit, the IRS ultimately holds the taxpayer responsible for the content of their payroll tax filings. So while a preparer not necessarily conducting the appropriate due diligence is certainly something that can be used as exculpatory evidence, it by no means is a silver bullet for the taxpayer to avoid any negative consequences associated with filing a payroll tax return that is not proper. And so now let's look at the various types of penalty structures for improper payroll tax returns. So first of all, assuming that the IRS disallows the payroll tax return and reverses the Employee Retention Tax Credit, you're looking at three basic penalty structures. Number one is an accuracy-related penalty, which is 10% of the understatement or erroneous claim. Number two would be the more serious erroneous claim penalty, which is usually about 20%. And number three would be the civil fraud penalty, which rises to 75%. Now, it's difficult to know at the outset which penalty structure the IRS is going to use because it really depends on the facts and circumstances of the individual case. More so in smaller matters or in matters that don't involve some sort of substantive investigation, you're going to see a lot more 10 and 20% penalties, particularly for taxpayers that are in credit categories of, let's call it, over $500,000 in total credits, or perhaps over $100,000 issued per quarter. You're going to see the IRS assess some of the more serious penalties. The most serious penalty is the civil fraud penalty. In addition to having to pay the tax back and associated interest, the IRS can charge up to 75% of the amount that is due. And so when you're dealing with a civil fraud penalty, or really any of the penalties, what the IRS focuses in on is the conduct of the taxpayer. Did the taxpayer make a simple mistake? Was the taxpayer negligent in their responsibilities? Or did they go beyond negligence and were they either reckless or were they either willfully blind? Now, negligence is the most common penalty, and that's usually around the 20% range. So it speaks to the erroneous claim side of things. So this is where the preparer gets back into the conversation, because even though the preparer put together the claim, the taxpayer probably had an opportunity to review it and or follow along with the substantiation or the guidance that should have been provided at the time the return was filed. If no guidance was provided to the taxpayer, then the taxpayer reasonably had a duty to request such guidance. So in mitigating negligence, it really speaks to intent. What was the taxpayer intent? And what did the taxpayer do at the time the credit was filed that would have potentially mitigated this circumstance? And so now this is where we come into the concept of how do we deal with penalties once they are assessed, or how can we be proactive in dealing with penalties? When you become aware that there is a problem, if you go report it to the IRS, or if you go take corrective action prior to the IRS catching you, then it makes the underlying conduct a lot less bad. Because essentially, without prompting, you're pushing things forward so that the government doesn't have to. When the IRS catches you, then you're faced in a little bit more of a precarious situation. So when you're mitigating penalties, there's basically two things to consider. Number one is, when were you aware, or when should you have been aware, that there was an issue or problem on your tax return? And number two, when you found out about it, what measure of corrective action did you take, and how quickly did you take that measure of corrective action? The IRS really wants to see forceful effort on the part of the taxpayer to correct the mistake. So if you're in a situation where penalties haven't been assessed, then that's great, because now is the best time to mitigate IRS penalties. You're aware that there might be a problem. You can do a due diligence review to see how big the problem is. And then you can take appropriate corrective action depending on the scope and size of the problem. If a penalty has been assessed, then you're basically in the position where you're going to have to state your case and say, look, this penalty was assessed, but it wasn't assessed correctly because we did everything in our power to help deal with this penalty. Once you have these basic criteria down, there's a couple of ways that you can mitigate penalties. The most common way of mitigating penalties is through what we call a penalty abatement letter. So it's a letter that gets submitted to the service that says, essentially, in a nutshell, please don't penalize me, and here's why. But in reality, what it is it's a breakdown of why the IRS assesses penalties. The IRS doesn't assess penalties to be punitive. They assess penalties to bring taxpayers into compliance. So essentially what a penalty abatement letter would do, break down the statutory scheme and make the argument that the penalty really doesn't serve any purpose, because if the purpose of penalties is to promote compliance, you as a taxpayer did as much as you possibly could to be in compliance. If you don't want to go the traditional penalty abatement route, you can submit what's called a doubts to liability offer and compromise, where you say, hey, I don't owe this, and here's why. You can go through the IRS Appeals Division to do that, or you can wait until the penalty enters into the collections department, and there are some specific collections challenges that you can do there. Which path is best for you is a difficult decision, because obviously things are more fact specific when you get into that level, and depending on the facts of the case, that's going to change the playing field on which you want to fight the penalty battle. It depends on who the client is. It depends on what state they filed in, how egregious was the promoter conduct, how egregious was the client conduct, and really how much money are we talking about. And so in looking at all these factors, you want to really analyze and make a strategic, forward-thinking decision on how to deal with these issues in the best way you can. As I mentioned, it's not just the penalties. It's the tax, it's the interest, and the penalty on top of that. So the quicker you can get out of a situation for as little damage as possible, usually the path of least resistance is the best one you want to take. For more information, you really need to seek out the help of a qualified tax professional who can kind of walk you through what the playing field is, what it looks like, and get you across the board as quickly as possible.